Want to quit your job on $60,000 a year? Let's do the math. At a 4% income yield, you'll need about $1.5 million. At 3%, that's about $2 million. Sounds impossible, but not completely. If you stack the right dividend, treasuries, and ETFs, if you automate buys, and if you let dividend growth do the hard work for you, then it might work. I'm going to show you the risk, the mix, and a 10-minute plan on how to turn investing into a paycheck. Let's jump in. As always, I would really appreciate it if you like this video and if you subscribe to my channel, especially if you learn something new. So with that, let's talk about the goal of today's video. Let's say you earn about $60,000 a year. Now, why did I choose this number? It's based on this Social Security statement here, and it's based on the latest index from 2023, which mentions that the average American earns about $66,600, so I rounded down to 60,000. That's where I came up with the 60,000 number. So let's say your goal is to retire at some point and you want to replace this $60,000 a year number from your actual 9-to-5 job with $60,000 a year in passive income. So passive investing income, I should say. How would you be able to do that? Well, the good news is I have a formula here that I will show you, and I will share with you a couple of ETFs that I personally would invest in and actually have invested in that generate good income. These are called high dividend ETFs. So the question that a lot of people ask me is, Fiona, how much principal do I actually need to generate $60,000 a year for this scenario? Or in other cases, like when I used to be a wealth advisor, their question was, how much do I need to generate $200,000, $300,000, $400,000. And here is the simple answer and the simple math that I share with most of my clients. The answer here is that you want to put whatever income that needs to be replaced. So income replaced, I'm going to put here, that's the variable. And you want to divide that. So in this case, it's 60,000 that we want to replace. We want to divide that by the yield. So the yield varies, of course, but we need to take an average. The yield essentially means what is the income that is being thrown off of a particular investment, whether that's an ETF, whether that's a treasury, whatever it is, right? So each treasury, each ETF generally has an income, especially if it has a dividend within it, right? And we'll get into that in a moment. But here's the formula. So let's actually walk through this in a real world example. So I use this example, VYM. It's actually one of my favorite ETFs to invest in. It's a high dividend ETF, and it's from Vanguard. Vanguard is generally low cost. How is it low cost? If you take a look at the expense ratio here, it's only 6 basis points, right? Or 600ths, or 0.06%. So very low. A typical high expense ratio would be about 1%, or maybe it would be about, 1.5%. So this year's just 6 basis points, so very low. Now, let's take a look at what the yield is in this real world example. As you can see here, the 30-day SEC yield is about 2.57%. So let's apply this to our formula that I just showed you. So our yield, 2.57, which equals this. So if we do 60,000 divided by this number, we would be looking at about $2.3 million for capital that we would need. So if our yield is this 2.57%, right? This here's 2.57%. We convert it into a decimal. So this equals 2.57%, this decimal, 0.0257. We divide 60,000, which is our income goal, by this yield. And so now we get what our target amount is, our target amount of money that we want to accumulate, so our capital, in order to throw off this $60,000 a year. So in order to get $60,000 a year, our target income number, with a 2.57% yield, we will need to invest $2.3 million. At $2.3 million, you are able to withdraw $60,000 a year. So mind you, this does not include tax considerations, because that is a whole other story, and I have a section on that. So make sure you check that out, because this taxes will also come into play. If this here, for example, is a pre-tax account, in other words, the $60,000 is actually taxed, you might actually need more. You need more capital because this 60,000 actually won't be 60,000 in your bank account. If taxes are taken out, it might be like 50,000 or 55,000. So we need to make sure we keep that in the back of our minds. But right now, taxes are not in this consideration in the calculation. So here's another example just to make sure we solidify the formula. So in this case, we're looking at SCH. This is from Charles Schwab, and it's a fund based on the SEC 30-day yield about 3.75%, so considerably higher. So again, let's plug this into our formula. First, we want to convert 3.75% into a decimal format. That goes to 0.0375. Now we're going to plug this into our formula that I gave, our goal for income replacement, $60,000. The yield, which we just calculated, to 0.0375. We do the math and we find out that we actually only need 1.6 million. And I put only in quotation marks versus previously what we needed was 2.3 million. So automatically when I zoom out, you can see a pretty big difference, right? You can see that with a lower yield at 2.57, we need capital of 2.3 million. With a higher yield of 3.75%, our capital requirement is 1.6 million. So automatically you can see that there is already a very big difference, $700,000 to be exact, right? So you need $700,000 less. Now, what does this mean? And this is the key driver of this entire video. It is that a higher yield means we can afford to have less capital requirement. Now, the goal, of course, is to understand that a higher yield doesn't always mean quality. Oftentimes, having a higher yield, and by high, I mean typically like greater than 5% yield, that might mean that there are some risks associated. Just as the general investing adage or the investing saying says, if you have a higher return, then that means you also sometimes take a higher risk. And the same thing goes with dividend yields. If you have a higher dividend yield, that means you're likely taking a higher risk. And now the question is why? Where is this risk buried? And that is up to you, of course, to find out. Oftentimes, an acceptable yield without really too much head scratching and thinking that there is a lot of risk buried, for me at least, it's typically between 2% to 5%, I would say. Generally, I'm not too concerned. If there is a yield that's higher than 5% or maybe higher than 8%, then I would start thinking, okay, what's the catch? Why is this so high? Are they trying to attract investors and maybe the company's going bankrupt? Is the company seeing a pretty big lawsuit emerging? Is the company losing a patent? Is the patent expiring, et cetera? So those are some questions I would start asking myself. The other thing I want you to keep in mind is that yields really do vary. So this here is just a snapshot, right? So when I say this formula, this specifically, dividing whatever your income requirement is, in this case 60,000 by the yield, that yield generally should be an average or perhaps a conservative, in other words, a lower estimate of where the high point of the yield would be. You don't want to take the high point. You want to take a low point. So you have more capital that you will need to invest in or more capital that you want to acquire. So it doesn't make it look, you essentially don't under promise. The next thing that I want you to take a look at is some of the tools that you can use in order to achieve a higher yield. Now, I looked at 5 distinct buckets, and I'll show them to you, and then I'll actually zoom into each bucket. So the first bucket to gain higher yields, and that, again, I have invested in myself, are core U.S. dividend ETFs. You really can't go wrong with them. The second bucket is international dividends, so not U.S., anything outside of the U.S. The third bucket is dividend growth ETFs. The fourth bucket is REITs, so these are real estate investment trusts. And then finally, the last bucket is really a paycheck smoother, or more specifically, has to do with Treasuries. And we'll talk about each of these in depth, and I'll share some examples that I myself have used. And then we'll go into some of the tax discussions and how each of these are taxed, because taxes will play a role in how much money you need or how much more you need to aim for. So first, let's talk about the core U.S. dividend ETFs. Now, under that, the goal really is quite simple. You have high quality and low fees. That's very simple. And the good news is we already looked at 2 of them. So the first one is SCHD. This here's Schwab. The expense ratio is 6 basis points, so very low, which is good news. The regular SEC yield is 3.75. Again, we looked at this, so I'm going to keep going to save time. Here, I wanted to share a Morningstar review of the overall performance of SCHD. You can see that here, here's the price of the investment. It's this light blue line, and where do we see it? We essentially see it up here, which is actually higher than the category, which is red. So compared to its entire category, this particular fund, SCHD, is actually performing quite high, in other words, better. And that's good, right? And even compared to the index, which is yellow, it has been performing above or in line. Now, I do want to make a very clear distinction. If your goal is dividends, then you really shouldn't pay too much attention to the price, right? Because dividends are completely separate than price compared to price. Oftentimes, you might actually have companies that increase their dividends when the actual price of their stock or ETF is much lower. And this oftentimes happens during recessions, right? So during recessions, the actual price or the value of their ETF stock or their stock or their ETF decreases because people sell. And how do these ETFs or companies generally retain investors? By increasing dividends. So oftentimes, just make sure you have that distinction. If your goal is income, okay, then you want to focus more so on dividends and not so much the price. So in other words, what I'm saying is this chart, while impressive and good to see, really shouldn't be the end-all be-all driver in making your decision of whether or not to buy SCHD. The real decision, assuming your goal is income generation, which is what this video is about, you want to focus more on that dividend yield, which we looked up here. All right, moving on to the second example, VYM. This here is Vanguard. Like we spoke about before, it's broad, large cap, and it has a decent yield. Again, the expense ratio is generally low. We're looking at 0.06%. The yield is 2.57%. And here's just a quick overview. We're looking, pretty good compared to the category. So the red is the category, so it's doing very well compared to the category, but a slightly underperformance in the index overall. Again, not a big concern because our goal is income generation. The next category is international dividends. Here, we want to take a look at SCHY, which is also a Schwab index fund. So for SCHY, we actually see a much higher yield, 4.2%. And we see a generally pretty low expense ratio, 8% or 8 basis points, which is very low. Here you can see that this is relatively new. This would give me a little bit of pause, honestly, because I would think, okay, this is brand new, just started after COVID. Maybe I would be a little bit hesitant to invest a lot of money into this particular fund, but clearly it's, this here is the category in the index, and it's performing just slightly underneath. I wouldn't be too concerned, but because it's so new, I might have a little pause. So I would go to example number 2, which is VYMI, which is Vanguard. I would probably be a little bit more prone to investing in this. However, if you take a look at the expense ratio, it's pretty high. It's basically double of the Schwab expense ratio. So that's a downside for this Vanguard fund. So just something to keep in mind. The dividend, however, is 3.96%. And the other thing I wanted to point out is that the dividend growth has clearly been a positive trend upward. So 5.25%, that's good. And then finally, if we look at performance, this dotted blue line is clearly outperforming the category and the index. So also good news, even though not so much relevant. Let's move on to the next category, which is dividend growth ETFs. Also, I wanted to take a quick pause and say if you're learning new things and you really enjoy this content, please make sure to subscribe to my newsletter, which is in the description in the link below this video. It is in the pinned comment. All right, with that, let's keep going. Dividend growth ETFs. The very first example I wanted to share is Noble, N-O-B-L. And this here is essentially an S&P 500 dividend aristocrat. As you can see, over the last 5 years, it's gone up 40%, which is good. At least it's not negative, right? And you can see the general trend is upward. Specifically, I wanted to look more at this graph here. And I wanted to look at the expense ratio, so a little bit more expensive than what we're used to. It's 35 basis points. And I also wanted to look at the yield, which is 2%. So not as high as the previous yields that we looked at, but not terrible. I personally would probably hold off, mainly because for me, this expense ratio and this yield, I'm not positive about it. Like I don't feel that great about it. I would probably invest more heavily in the other ones, but I'm not disinclined from Noble because clearly it has done well. It has seen positive returns. The second example here, for me at least, would be Regal, REGL. It's an S&P 500 or S&P mid cap 400. And again, you've seen general positive trend over the last 5 years. It's been up 53% roughly. And we can see that, so that's good. And then finally, if we look at this data here, expense ratio, again, a little bit high. I'm a little bit hesitant. I think I'm spoiled with lower expense ratios, if I'm being honest. And the yield is 2.3%. So, in general, something I should mention is that this particular category, dividend growth ETFs, they're growth oriented, right? So if they're growth oriented, they're probably not going to throw off as much in dividends because they are growth oriented. They're looking to gain appreciation in price, for example, which is exactly what we've seen. So you can't have both, right? You got to take one with the other. REITs are next. So these are real estate investment trusts. They are essentially buckets that invest in multiple real estate properties, and each bucket can be tilted toward things like healthcare, for example. This is a very common one of my favorites personally, because, let's face it, humans need healthcare, whether you're in a recession or not. If you're sick, you generally want to go to a doctor or hospital or other area. Nursing homes are a very big one, and there's oftentimes consistent income. Hospitals generally pay their bills, at least let's hope so. Nursing homes do the same thing. So what I'm saying is there's generally quite steady income stream with REITs, depending on the type of category. There's other things like commercial REITs too, for example, which might be a little bit higher risk, but also higher reward. So the first example is SCHH. This here's also Charles Schwab. This here is essentially a property owning REIT basket. Dividends, they generally are ordinary income taxed. Again, we will get to the taxes here in a moment. Something I did want to mention though early is that by law, REITs, they do distribute 90% of taxable income to shareholders. So that's something to know. I thought it was good to know. So this SCHH Schwab REIT, again, over the last 5 years, 15% growth. I think that's relatively in line. Again, REITs is real estate, so we're not going to see 50% growth unless you're in a very geographically concentrated REIT like Miami, for example, that has seen high growth, or parts of Texas, for instance. So it depends on the geography as well. But I'm not shocked that this here isn't like 50 or 60% growth. I'm okay with that. The expense ratio is 7 basis points, so I'm happy with that. And the overall yield is 3%. So again, generally happy. One word of advice, though, is mortgage REITs. If you do decide to move forward with mortgage REITs like MORT, they do generally have good yields, but there is also a lot of volatility. And dividend cuts certainly can happen. I'm just thinking back to the great financial crisis of 2008. So personally, I would steer clear of that. And let's check out the paycheck smoother bucket. This is the last bucket before we go into taxes and other areas. This here mainly has to do with treasuries. So treasuries are generally a little bit more safe because they are oftentimes associated with the government, right? And oftentimes, at least with the US government, you would expect the government to pay. And so it is considered stable, which means that the reward or your return is lower than perhaps with other high dividend assets. So in this example, I'm going to share SGov. These here are iShares. They're 0 to 3 month T-bills or treasury bills. The interest is generally federally taxable, but state and local tax exempt. So if you live in a high state income tax area like California or Hawaii, for example, this is good news. Here's an example of this particular SGov fund. We see that the trend is upward, but also I want you to take note in case you're thinking it is extremely volatile. Look at the increments here. We're looking at 100.68 versus like the lowest here of 100.2. So we're not even talking within the same dollar range. So it is quite stable. So just look at the increments that it moves into. The overall expense ratio is 9 basis points and the yield is 4.52%. So to me, that would be something I would be interested in. And then finally, BIL is another example that I personally would be interested in. It's from State Street. It's a SPDR fund, and this is also a 1 to 3 month T-bill, a treasury bill. So we can see that the expense ratio is a little bit higher. Makes sense though, because it is from State Street. So State Street does have a little bit more like more managed funds, right? This here's 0.1356 percent. So I think that is it's a bit higher than the previous ones. And finally, you see, where's the average yield? This here's the average yield, 4.24%. Average yield to worst is just another way of saying that it's essentially the most conservative measure. So like the lowest yield that you could get is 4.24%, which isn't bad. I personally would probably invest in this one because of the lower expense ratio and the generally good yield, 4.52%, which is higher than this yield. Again, yields vary though, so just keep that in mind. So how much should you invest of each? I don't know about you, but I'm going to talk about what I personally would do and have done in the past, at least in my conservative bucket, in my conservative portfolio, which is not much, but there is still some because I do care and value about dividend investing. So I personally would do the following if my goal was to focus on income. If my goal was to focus on growth of income, I would do it a little differently, but not by much, but a little differently. So I'll get to that in a second, but first let's focus on income first. So I would structure it this way with these 5 funds. So first, 35% into SCHD, then I would do 25% in VYM, 15% into SCHY or VYMI. I would probably take the Vanguard option. 10% into SCHH, and then finally into the T-bills, 15%. Because again, they're kind of lower risk and their returns are generally pretty good. Now, if I were to look at growth of income, I would keep the same amount for investment purposes for SCHD. This year would be a new category, so Noble and Regal, because this year's again growth oriented. So we saw that earlier, like over 5 years, they've grown about 50%, 40%, depending on which one you look at. This year, VYM would go down in allocation from 25% to 15%, so I would decrease it by 10 points. SCHH would be the same. And then finally, the T-bills, I would go up just because, again, I know that there's a lot of income, at least based on the yields currently coming from them. So there's a little bit of a difference, but again, you got to do whatever your goal is and however you feel comfortable. This is just something that I would do as an example. Would love to know what you think in the comments. And now let's talk about the fun stuff, taxes and reinvestment. What actually hits your wallet? Now, before I jump in, again, I just want to take a quick pause. If you like this content and you want to sign up for more, please make sure you check out my newsletter link, which is in the description in the pinned comment below. So with that, let's talk about, I think I have 4 categories. Yep, 4 categories of taxes. First, we're going to talk about qualified dividends. So qualified dividends, as this explainer says, they're essentially taxed as long-term capital gains rates. And long-term capital gains are much more favorable than short-term capital gains. Short-term capital gains are taxed at your ordinary income tax brackets, and they're like 5 or 6 or more. Ordinary tax bracket or qualified or long-term capital gains rates, also known as qualified dividend rates, they only have 3 tax brackets, these 3. And how much you're taxed for qualified dividends really depends on your overall income bracket. So if you're single and you make between $0 to $48,350, then you are not taxed at all for the income that you earn on qualified dividends. If you are married and you earn your household earns between $96,000 and $600,000, well, then you have to pay 15% of your qualified dividends and so on and so forth. So that's the tax rates. The next thing that you want to take a look at is Treasury interest. This here is based on the IRS, and I'm going to zoom in. Interest income from Treasury bills, so T-bills, this is what we were talking about with SGov, for example. Notes and bonds, so this interest is subject to federal income tax, but it is exempt from all state and local income taxes. And that's what we spoke about before, so it's not news. REIT income, so this here's real estate investment trust income. This year I thought was interesting because for the majority, in this case 79% in 2023, it is essentially ordinary income. But there are some REITs, they're quite rare, but there are some REITs that are taxed 11% to be exact as long-term capital gains, which is more favorable, and then return of capital 9%. We're not even going to go into that. But essentially just know for REITs, chances are you are going to be taxed at ordinary income brackets, which is unfavorable. And finally, I've had a couple of questions from clients saying, Fiona, what if I do a DRIP plan? Now, for those of you who aren't familiar with DRIP plans, those are dividend reinvestment plans, where essentially if you're paid a dividend, you then decide instead of putting it in cash in your bank account and spending it, you actually reinvest the dividend. So you take the dividend and then you buy more of that ETF or of that stock, which then would ultimately lead you to getting a greater dividend whenever the next dividend comes because you own more of that stock, you invest more, you buy more, you get more, and it's an upward spiral, which is good. Now, some people think that if they reinvest their dividends, they don't actually have to pay taxes in that year because technically they're reinvesting them. But that's not really the case. And I got this from Investopedia and a couple of other sources as well to show you visually that choosing to reinvest your dividends is the same thing as receiving the dividends in cash. So what does that mean? You will probably have to pay taxes on them. So how you're paying depends on if they're ordinary or qualified, but you will have to pay taxes in the year that you receive them. Now, of course, it also depends on the type of plan you have. So there are plans like Roth plans, like a Roth IRA or a Roth 401k, and then there are plans called pre-tax plans. These are traditional 401ks or traditional IRAs. Generally speaking, you also have a taxable account. Taxable accounts are like your regular investment account. These are the ones that you have to pay in the year that you receive the dividend. Generally speaking, these accounts, which are qualified accounts and they're retirement accounts, most often, if you receive a dividend here, chances are you're not going to have to pay, at least not in the year that you receive it. So make sure you understand what account you are also actually investing in the dividends. If the goal is to generate income, but possibly for like 30 years down the road, does it actually make sense to put money into a taxable account now, like to invest in dividends in a taxable account where you're already at a pretty high income tax bracket? Likely you're working, you're making money, and now on top of that you're adding dividends that are generating income for you. I don't know. I mean, I don't know your situation, but this is something I would be thinking about myself. So I would probably buy a lot of the income in a Roth, personally, for me, in a Roth account where, it's tax deferred. I don't have to really pay taxes this year. So that's just something to think about and also to talk with your accountant because I'm not an accountant. And so now let's talk about the game plan. We got a couple of check boxes here, 4 to be precise. First, how do you win? You always want to be buying with an auto dollar cost averaging plan. So everything should be automated. You want to become the automatic millionaire. Don't leave it to, a reminder that you set for yourself. You just want to buy on an autopilot plan. So make sure you set it up and you set it and then you forget it. Make sure that your DRIP, your dividend reinvestment plan, is on. So your DRIP plan is on. You don't have to think about it. When you get a dividend, it buys more of the stock, which buys more of the dividend, and it's an upward cycle. The next thing is make sure to measure the income, not the price. This goes back to what we were talking about. Really, if your goal is income, then you should not be worried about the price of a stock or of an ETF. It doesn't matter, right? What matters is the income of the dividend, of the yield. Has the yield been increasing over time? That's the question you want to ask. And then finally, also something to think about that a lot of people forget is rebalancing your portfolios. Sometimes something occurs that's called portfolio drift, which means when one asset class maybe gains a lot more value in a much shorter period of time than other asset classes, and then that causes your entire balance, your asset mix, which we went over here, at least for me, it might cause this asset mix to go out of alignment. So maybe this 35% all of a sudden goes up to 42%, and maybe this 25% actually contracts to 16%. Well, now we're no longer equal. We need to trim or sell this 42% and essentially, bring it back to 35, and we need to buy more of VYM to bring it up to 25, and then also arrange the rest down here. That's what I mean by portfolio drift and making sure we rebalance the portfolio. And finally, just make sure you have a reality check with yourself. So This here I thought was an interesting report from Morningstar. So they definitely know what they're doing. They have a great research team. And this here looks at what is your safe withdrawal percentage from a portfolio. And it's also based on asset allocation. So on average, they actually say if your goal is to live in retire, if you think you'll live in retirement for 30 years and you have a balanced portfolio, so we're looking at 50% in equities, right? This here's equity weightings, then you are probably going to be able to withdraw about 3.7% of your portfolio. That is roughly the safe withdrawal rate. It used to be 4%. That was the high mark. So it is a little bit lower. So now let's actually look at this again using our formula from earlier. At $60,000, if this is your goal to replace at a 3.7% safe withdrawal rate, that implies that 60,000 divided by 0.037, this is converted, right, into decimal format, you're looking at $1.62 million in capital needed, which is better than $2 million needed, right? But still, it's a good chunk of money, and it might be difficult to get there. So the most important thing is to start building wealth now. Remember, let compounding interest and let compounding dividend growth do the hard work for you. If you found this video helpful, please like and share to help others. I would really appreciate that. Subscribe to my YouTube channel. It's at _, don't forget the _ MMW for more cool insights. And of course, please join my newsletter for more exclusive tips. The link is in the description below. Your bank accounts will thank you later. Take care.